Do you hate the thought of working past 55 or 60? Do you hate not being able to live the life you deserve today? Do you hate not knowing what your financial future looks like? It's time to stop doing what you hate. Here's your host, Mr. Harold Green.
Hello, everyone. Welcome back to the show. I'm Harold Green of Brightree Wealth Management, and it is time to stop doing what you hate. This is episode 8 of our ongoing series, Financial Advice versus Financial Propaganda. And in the last episode, we exposed hidden fees, hidden risk, and hidden incentives, the structural forces quietly shaping retirement outcomes behind the scenes. And today we're gonna talk about something even more dangerous. It's not a product, it's not a fee, it's not an advisor, but a period of time. Because there's a window in every retirement where the margin for error collapses and mistakes become permanent, and traditional financial advice quietly stops working, and you don't even know it. And this is what I call the retirement danger zone. And here's what the retirement danger zone is and is not. The retirement danger zone is not a market crash, a recession, specific age, or even a single bad year. It's a sequence of years. Typically, it begins shortly before retirement and it extends through the first decade after. And during this window, the rules change. Strategies that worked 30 to 40 years ago during accumulation suddenly become liabilities. And volatility stops being your friend. Time is really not on your side here. Averages stop protecting you, and recovery becomes optional instead of guaranteed. This is complicated, but hang in there. Now, why these years matter more than any others? Most people assume retirement risk is evenly distributed over time. It's not. Risk in retirement is front-loaded. And the first 5 to 10 years matter more than the next 20 years combined. Why? Because this is when the withdrawals begin. Contributions stop. Compounding reverses direction if your portfolios are not managed correctly. And early losses permanently reduce future income. And a poor sequence early on can damage a plan beyond repair, even if markets perform well later. I don't want to get into it right now. I'm trying to hold myself back. This is why retirees, you can have two retirees with the same portfolio, the same return, and the same spending can end up with radically different outcomes. Timing, not intelligence, determines the results. And if you got somebody managing your portfolio that's asleep at the wheel, we're headed for disaster. Now, why this is rarely explained clearly. The retirement danger zone is rarely discussed because it complicates simple advice, okay? It undermines set it and forget it narratives. It exposes the limits of buy and hold. It requires planning beyond averages. Simple rules sell better than conditional ones. But retirees don't live inside averages. They live inside real sequence of returns. Now, the three forces that define the danger zone. All right. The retirement danger zone is shaped by three interacting forces. Number one, sequence or return risk. Number two, volatility drag. And number three, withdrawal math. And individually, each is manageable. Together, they can quietly destroy retirement income or your ability to take monies out of your account. And in this episode, I'm going to break down all three. I'm going to do it clearly. I'm going to do it calmly. And I'm going to do it without fear-based language, because fear-based language is propaganda. Because understanding the danger zone is not about panic, it's about preparation. Are you ready? 1, 2, 3, let's get it. Kind of late on that one, huh? Setting expectations for this episode. Here's what we're going to do. In this episode, we're going to cover why early losses matter more than late ones, how volatility mathematically reduces long-term income, why withdrawals change everything, and how traditional advice fails inside the danger zone, and how retirees can structure their plans to survive it. And I do this in a program called Rapid Retire, and I'll talk about that later. And hopefully by the end, you're going to understand why most retirement failures don't happen at 85. They happen between 62 and 72. And this is when people are most prone to make the biggest mistakes. And more importantly, you'll know how to avoid them. And I'm going to tell you something. This is why I feel that this is where they make the biggest mistakes, between 62 and 72. They just retired. What do they have to do all day? In a lot of cases, absolutely nothing. So what do they start fumbling around with? They start fumbling around with their portfolio. They start doing research on the internet. They start hopping on all these things and saying things like, hey, I'm retired now. What is this thing supposed to look like when I'm retired? What is it supposed to look like before you retire, not after? That's crazy. And here's what I'm going to talk about next. I'm going to talk about the sequence of return risk and why average returns are meaningless once withdrawals begin. Holding myself back. Now, how can I say this? Most aggressive investors, they dismiss sequence of return risk as something that only matters to retirees pulling income. That dismissal is one of the most expensive mistakes aggressive investors make. It's not about age, it's not about retirement, it's about capital timing. And sequence risk exists anytime capital is deployed unevenly, exposure is concentrated, and then leverage is involved. Liquidity is limited, or capital must be reallocated after losses. I'm going to give you guys a sneak peek into my mind on how I trade aggressively for my clients that are in our rapid retire program. We got three buckets: a short-term bucket, which is not, super complicated; intermediate bucket, which is a moderate type of bucket; and we have a long-term bucket, which is all gas, is what I call it. Okay. Now, at certain periods of times, all three of your buckets can be all gas, depending on your risk. If you say, Harold, I'm a risk score of 99, that means you're the most aggressive investor. I can literally have all three of your buckets on all gas all the time, but I don't do that. Okay. Because there's a financial plan that dictates that. And going from being conservative to moderate to aggressive in three buckets to going all gas, there has to be a period of time that dictates that, or some kind of catastrophe that we take advantage of. I'll get into that later. Now, aggressive investors, they encounter sequence risk constantly. They just call it something else. It could be bad timing, unlucky entry, like, early to the party kind of thing. Sometimes you're early and the market's staying irrational. Like, man, these people are stupid. Why are they selling this thing? They should be in it. It's hot right now. Like, why are they selling this thing? It should be going straight to the moon. Things like that. But mathematically, it's all the same problem, right? Okay, the portfolios go down. The question is, how fast can you get them back up? If you're not doing it the right way, it's a problem. Now, here's the core truth aggressive investors that hate. This is something that they want to hear. You can be directionally right and still permanently impair capital. Like you can be in the right trade and the right theme, but it's the timing. Markets don't reward being right eventually. They reward surviving long enough for being right to matter, right? Again, it's about themes. And sequence risk is what kills capital before the thesis even plays out, right? You got in the wrong trade at the wrong time. The thesis is right, but you need time to let that thing play out. And here's why losses early are more dangerous than losses late. So let's remove the emotion and talk math. A 20% drop needs a 25% gain to recover. A 40% drop needs a 67% gain to recover. A 60% drop needs a 150% gain to recover. Now, where the heck are you going to get a 150% return gain? Like, how can you get that? It's hard, but here's the thing though. How do you get that on a consistent basis? Not like once or twice, right? But 5, 6, 7, 8, 9 times. How do you consistently get that? I'll share that with you at the end of the show. And aggressive investors, they understand this intellectually, but they ignore how early losses constrain future opportunity. Early drawdowns, right? Reduce positioning, sizing, power. You can't get enough of what you really need. Force leverage at worst prices, right? Increase emotional decision making, compress optionality, eliminate patience. Oh, this is a good one. Whoa. Later losses after capital has compounded are survivable. Early losses redefine the entire game, right? You lose all that money up front. Look, if you're doing it yourself, it takes what? 6 years to get that money back, depending on, because you don't go in there all aggressive at the right time. Like you lose money and then because you sold at the wrong time or you had to rebalance at the wrong time, the portfolio's down 30, 40%. And now you got a gunshot to get back in. It's hard. This is why aggressive investors often fail after their best ideas, not the worst ones. That's crazy. So aggressive portfolios, they almost share these traits. Number one, high concentration, thematic exposure, narrative alignment, volatility tolerance, conviction-based sizing. Now, these are not all bad things, all right? This is where active money management has to be involved. You can't be like highly concentrated and buy and hold like that because these things will change and turn upside down on their heads in a minute. It could be a trading day. Now, this combination, it magnifies sequence risk, not because, like I said, the ideas are bad, But because volatility interacts with position size and timing, this is all complicated stuff. Now, a concentrated portfolio experiencing volatility early in a thesis forces rebalancing decisions, pressures conviction, triggers margin calls. Oh, this is a nasty one. And it narrows your future opportunity, right? I've seen this before. I've had clients in positions like that. And it was like, yo, why are we doing this? And they said, well, I believe in this. And I was like, we're buying it on margin. It's like, it's going to take off. Yeah, the thesis is right, but the timing is like, we can't wait it out. And so for a lot of those guys, we had to make some changes because they were highly leveraged and believing in one particular thesis or narrative that it didn't play out. It didn't play out well. And we had to take some heavy duty hits. Now, a lot of times how can I say this? I'm managing 100% of, like, I would say 99% of the time I'm managing the portfolios, but every once in a while I have a client who really has conviction about something. And my question to them is, can they afford to have this conviction? If they lose all of this money, are they still going to be able to eat? And if they say, yeah, Harold, I mean, this is just some of the money I have, like it's just a small portion of it. I'm willing to just go like this with this. I just maybe need some guidance from you here and there, but I'm willing to go like this. It's okay, fine. All right. But this is not for everybody. Okay. So here's one of the problems super aggressive investors they get into. They'll say, I'm not wrong. I'm just early. Have I been guilty of this? How can I say I'm not guilty of it? But I'll say this a lot. I'm not wrong. I'm just not right now. I will be right eventually. The question is, do we have the capital? Are our buckets structured so that we can wait it out and be right? Because boy, I tell you, when you're right, you are really right. But when you're wrong, you're really wrong. Sometimes it's, I'll move on. Some of the problems are you're early with too much size, too much leverage, too little liquidity, and too much identity attached, right? You believe in the thesis too much. You're not well balanced in your thought process. And so a lot of times markets, they don't pay attention. They don't pay interest on conviction. Like you're not getting interest income on your conviction. It just doesn't work that way. Sequence risk is the tax aggressive investors pay for confusing timeline certainty with outcome certainty. You have to understand that there's a certain outcome to your trades. There's a certain outcome. Now, here's what I'm going to stop and preface and say. That certain outcome can be within a range. Okay. You're right. Is it going to be a 5% return? Is it going to be a 100% return? Is it going to be a 2,000% return to the positive, right? Or you're going to lose everything in that trade. You have to make sure there is an outcome certainty. And that's why our trading can be quite complicated. And our clients just say, we just trust you. We just let you do whatever. The real question aggressive investors should ask is this. Instead of asking, am I right? The better question is this. Can my capital survive being right later than I expect? This is what I'm talking about. And that question determines position sizing, exposure layering, liquidity buffers, leverage use, risk segmentation, on and on and on. And this is one of the things that we do. We say, okay, how much Amazon options do we have right now for X strike price? Okay, this is what we have. How's it performing? And usually we're asking that question after we see the position already being destroyed. And if there's a long runway for it to be super successful, again, the question is how long is it going to take for us to be right? And if a client is needing income out of a particular bucket, normally we're not doing that in the bucket that they need income out of. We're doing it in their long-term bucket because that long-term bucket is 20 years, right? 15 to 20 years. Now, if I'm not right within 15 to 20 years, I need to lose my job. Okay, I shouldn't be doing this. All right. Very important. Aggressive investors don't lose because they take risk. They lose because they take fragile risk. Okay. That wasn't a well put together trade. So what do I want to talk about next? Okay. Volatility drag. And this is where some wild swings can destroy your compounding. And again, this whole conversation is about someone who did buy and hold, and they never understood all this stuff. They just went all in on a handful of trades, and they're just trying to wait it out. And aggressive investors are comfortable with volatility. I'm going to be right someday. This thing is going to go up and down. I'm just going to ride it out. They expect it. They expect drawdowns. They pride themselves on their ability to sit through it. But here's the problem. Volatility doesn't just test psychology, it damages math. Volatility drag is not emotional, it's mechanical. And the more aggressive the strategy, the more severe the drag. And here's what we're going to do. We're going to consider two portfolios. Portfolio A gains 20% one year and loses 20% the next. Portfolio B gains 0% each year. I don't know how you do that, but just here's an example. Portfolio A feels exciting. It's like it's dopamine. Yeah, portfolio's up. But in order for me to get excited, the portfolio gaining 20%, that's like, yo, 20%. Like, where's 10x? Anyway, portfolio A ends up down 4% over 2 years. Portfolio B breaks even. And this effect compounds as volatility increases, right? The wider the swings, the harder it becomes to compound, even if average returns look really strong. That's why I don't really believe in that. I believe in active money management. And sometimes high returns can still produce poor outcomes. Aggressive investors, they often quote average returns. I don't believe in average returns. I believe in actual returns, right? But averages lie in volatile environments. A strategy that produces big wins, big losses, inconsistent returns can underperform a smoother strategy over time, even if the averages look higher. Now, this is what I call psychological, like, it's the psychological security blanket of investing. I need a smooth portfolio that's going to get me X%. Look, sometimes you have to be able to afford that. But a lot of people I know, they can't afford that smooth 5% return every single year because they don't have enough money in their portfolios. They need 10, 15, 20, 30, 40% from time to time. They might need 100% one year. It just all depends. And you have to take advantage of the opportunities for these people. You can't sit there and try to smooth it out over time so people feel comfortable. That's why a lot of seniors that have these smooth portfolios over time, they end up living retirement lives that are substandard and they're just barely eking it out, or they can't take the trips they want to take. They didn't take the risk because they didn't like the volatility. Okay. That's crazy. And one of the things as a super aggressive investor, you have to watch out for something called the volatility concentration feedback loop, because high volatility encourages emotional rebalancing, leverage at the wrong time, premature profit taking. Ooh, this is a big one. And doubling down after losses. Like, yeah, I believe in this thing, man. Let's go hard on it. Let's go hard on it. No, no, no. Doubling down after losses. I don't like when the terminology gets to the point where we're talking about losses unless we're talking about real losses. What? If you sell something for a loss, like why would you go back in and double down on it? No, what this is talking about, you see it down on paper and you're chasing it down. This is what you're chasing it down. They call that doubling down after losses. You haven't taken any losses yet. You still have the same amount of stock, right? You're just buying more, even though the value of it has dropped. That's not a loss because you didn't materialize it. But some people chase these things down. In a lot of these behaviors, they increase volatility further. And volatility feeds behavior. Behavior feeds volatility. And the loop is rarely broken by conviction alone. These are some very important things. And I'm just going to talk real fast about the rest of it. Okay. Because being a very aggressive investor requires some things that, you know, I did a show one time. I talked about the toolkit, like the Smart Investors toolkit or something like that, like the Smart Investor skill set, like what you literally have to have in order to be an aggressive investor, or just say an investor, period, right? Most aggressive investors hear the word withdrawals and they immediately tune out. They think that's a retirement problem. That's for income investors. I'm reinvesting everything. I'm still in growth mode. That assumption is wrong. And aggressive investors, they experience withdrawals constantly. They just don't call them that. Here's where they show up, okay? And taking profits to redeploy the money, that can be considered a withdrawal. Funding lifestyle expenses, paying taxes, covering margin calls, right? Reducing exposure after drawdowns, reallocating capital to new ideas, extracting capital for private investments or ventures. These are all things. And also, if you're highly leveraged, there's interest that comes out of that account every month to cover the margin. That can be a withdrawal as well. And these are all some simple things that you have to understand. And one of the things I'm dealing with in my own personal portfolio right now is the tax situation. Okay. And I'm sitting at, I don't know, it's a lot of unrealized capital gain. And every year I wait for my short-term capital gains to turn into long-term capital gains. And right now I have some NVIDIA options in my portfolio that are up like 1,000%. And by the time you hear this show, I will have already taken care of the transaction because the option expires on, I think it's January 16th or something like that, 2026. So if I don't sell that option before then, it expires. So what do I need to do? I'm going to come in here on January 2nd, going to sell that NVIDIA option that's up 1,000%. It's long term, and it's going to kick my tax bill to 2027 versus me taking it now. And I've been writing this thing and writing this thing and writing this thing. I think it's an NVIDIA $53 call option that I bought when everybody was just like, oh, it's dead. NVIDIA's dead. It's not going anywhere. Just, just like, it looked bad. It looked really bad. So I went all in and I bought like super deep in the money options on NVIDIA, and they've exploded. And yeah, I've made a lot of money on it. I'm happy about it. But these are some of the things that you have to consider when you're investing aggressively, because sometimes that tax, how can I say this? You're scared. Okay. The closer you get to the option expiration date, like that's where your volatility can really increase, right? That's when it can really increase. When you have a long dated option and it's a deep in the money option, it doesn't move all that much. And so now I'm at the point where this is really when it's telling me, okay, you made the right trade, because again, NVIDIA is going through these wild swings, but it's not affecting my position on this trade all that much because I did the math the right way. And if you're investing and you're managing your own portfolio, these are some of the things that you really have to think about, right? How long can you survive, right? What does your long-term plan call for? Is my position size correct? Do I have enough time to wait it out to make sure I'm going to be right? If I'm buying options, did I buy a long-dated option, or am I just trying to quick trade the market, right? All of this really matters, but it only really matters depending on your strategy. And if you think you're getting there and you're about to retire and you're about to enter the retirement danger zone, if you want to make sure that you're not making these mistakes and you're running to issues where you take losses early on and now retirement looks like it's just crazy, before you even get there, I want you to go to my website, check me out, send us a request to make an appointment, get on my schedule, and it's free to talk to me, because I hate it when I see people in retirement that they lose faith in the system of investing because they made the wrong investment decisions or they trusted the wrong investment advice and there are no checks in place. They had no financial plan that does checks and balances, is the plan that determines everything. So get in touch with me, find out more about how we can make sure that you don't crack up in the retirement danger zone. So thanks for tuning in and listening to the show. Looking forward to sharing the next one with you folks. And until next time, everybody, 1, 2, 3, let's get it.
This is the podcastfactory.com.